Hey there, and welcome back to the Deep Dive. Ready to dive into some market trends?
Always ready to talk markets.
We've gotten a lot of questions from listeners about the Relative Strength Index, the RSI.
Ah, yes. The RSI, a classic.
And it seems like a lot of you have been checking out John Hayden's book, RSI, The Complete Guide.
Great choice. It's a really thorough look at the RSI.
So we're going to do a deep dive on some of the key insights from Hayden's book. See how it can help you level up your trading.
Sounds good to me.
Now, when people think about the markets, they usually jump right to price.
Right. Gotta look at those numbers.
But Hayden actually says that price is just a number.
Interesting take. What do you think he means by that?
Well, he says that every trade, every little movement on the charts, it all comes down to different perspectives.
Yeah, that makes sense. Every buyer has a seller on the other side of that trade, right?
Exactly. And they both think they're getting a good deal.
So it's like a constant battle of perspectives playing out in the market.
Exactly. Hayden uses the example of corn traders. You could have a small corn farmer. Okay. And then you've got a huge agricultural corporation. Their idea of a fair price for corn is going to be totally different.
Oh, for sure. Their motivations and their risk tolerance are completely different.
Right. And Hayden actually uses this analogy of being stuck in a trading pit.
A trading pit.
Yeah, like in the old days. He says if you're only focused on one time frame, like looking at the market minute by minute.
We're missing the bigger picture.
Exactly. It's like you're stuck in that pit, only seeing the orders right in front of you.
You don't see who's placing those huge GE orders that really move the market.
And he says this applies to everything. Stocks, futures, you name it.
It's about understanding those different time frames and the players behind them.
You've got day traders making split-second decisions.
And then you've got these long-term investors with strategies that span years.
So how do we even begin to make sense of all these different players and perspectives?
Well, that's where the RSI comes in. Hayden says the RSI can be a really powerful tool for cutting through the noise.
Okay, so how do we use the RSI to understand all of this?
Well, it's not just about whether the RSI is going up or down.
There's more to it than that.
It's about understanding what those movements tell us about the balance between buyers and sellers, the underlying forces at play.
So it's giving us a deeper level of insight into what's happening in the market.
Exactly. And Hayden has this really interesting table in his book, Table 3.
I saw that one. What's so special about it?
It shows how the RSI value actually changes in relation to the average gains and losses in the market.
Okay.
And get this, it doesn't move in a linear way.
What do you mean?
It actually changes logarithmically.
Logarithmically. Now you're just using big words.
It means the changes are more significant at certain levels than others. And that's something that most traders miss. They focus too much on those classic overbought and oversold levels of 70 and 30.
So those levels aren't that important.
Well, they can be, but they don't tell the whole story.
So we shouldn't just be blindly buying at 30 or selling at 70.
Exactly. Hayden points out that the most significant RSI movements often happen between 33 and 67.
That mid-range, why is that?
Because that's where those ratio swings between average gains and losses are most dramatic.
So even a small change in that range could signal a big shift in the market.
Exactly. And this is where it gets interesting. Hayden argues that in an uptrend, support is actually closer to 40 on the RSI, not 30.
And in a downtrend.
The resistance tends to be closer to 60, not 70.
So we're not just looking at those traditional overbought and oversold signals. We need to consider the bigger picture of the trend and these more nuanced support and resistance levels within the RSI. This is already making me rethink how I use this indicator. So we're starting to see how useful the RSI can be. But Hayden doesn't stop there, does he?
No, he definitely doesn't. He connects market movements to something a lot of people might not expect: Fibonacci ratios.
Fibonacci ratios? Like the Fibonacci sequence. The one with the rabbits.
That's the one. It's pretty amazing, actually. This sequence, where each number is the sum of the two before it, pops up all over in nature.
Right, the spiral of a seashell, how petals are arranged on a flower.
Oh,
It's wild.
Exactly. And Hayden believes these ratios, like the relationships between those numbers, play a key role in how the market moves, too.
Specifically, when the market retraces.
Yes. After a big move up or down, you almost always see a retracement, where the market takes a bit of a breather before deciding what to do next.
And these Fibonacci ratios can give us clues about where those retracements might stop.
Exactly. Hayden talks about these specific percentages, like 23.6%, 38.2%, and 61.8% derived from the Fibonacci sequence, as levels where the market often pauses or even reverses.
So instead of just guessing where the market might turn, we can use those Fibonacci levels as potential guideposts.
That's the idea. Understanding these retracement levels can give you a much better sense of how strong a trend really is.
A shallow retracement, say, around 23.6% would suggest a very strong trend.
Right? The market's just taking a little breather before continuing in the same direction.
But a deeper retracement, closer to 61.8%, might mean the trend is running out of steam.
Exactly. It's like the market's giving us hints about its next move, and those Fibonacci ratios can help us decode those hints.
Okay, I'm starting to see how this all fits together. Now, Hayden also brings up something called momentum discrepancy, reversal points, MDRPs. What are those all about?
MDRPs, those are fascinating. They occur when there's a divergence, a mismatch, essentially, between the price action you're seeing and what the RSI is telling you.
So the price is doing one thing, but the RSI is doing something else.
Precisely. It's like a hidden signal that the underlying momentum of the market, the real force behind the movements, might be shifting, even if the price hasn't fully caught up yet.
So it could be a clue that a reversal is coming.
Exactly. For example, let's say you see prices hitting a new low on the chart, but the RSI isn't confirming that low. That could be what Hayden calls an MDRP up.
An MDRP up. So it's actually a bullish signal.
Exactly. It suggests a bullish reversal might be in the cards, even though the price action alone isn't showing it yet.
And what about when prices are making new highs, but the RSI isn't?
That's what we call an MDRP down, and it's a potential bearish reversal signal. Again, the price is telling one story, but the RSI is hinting at something else entirely.
This is really interesting stuff. So we're looking for these divergences, these mismatches between price and RSI to spot potential reversal points.
Yeah.
But how do we actually use this information to trade?
Great question. And Hayden provides a formula for calculating potential price targets based on these MDRPs, which can be really valuable, but he emphasizes that it's absolutely crucial to consider these MDRPs in context. It's not enough to just blindly follow those signals.
So we need to use them alongside other tools and analysis.
Yes. Trend analysis, Fibonacci retracement levels, even trend lines drawn on the RSI chart itself. All of those can help confirm or refute what the MDRP is suggesting.
So instead of just looking at those basic overbought and oversold levels,
right, 70 and 30, those are just the starting point.
We're using the RSI to really dig into those nuances.
Exactly. Trend strength, retracements, potential reversals, there's so much information hidden in the RSI.
And I like that Hayden doesn't just tell you what to look for. He also talks about some of the common mistakes traders make with the RSI.
Oh yeah, he calls them the 10 RSI lies that traders believe.
They really get you thinking. Like, a lot of people think a bullish divergence always means the market's about to take off.
Right. They see that divergence and they're ready to go all in.
But Hayden points out that it's not always so straightforward.
It's about context. A bullish divergence might just mean a brief pause in a downtrend, not a complete reversal.
So you might actually want to use that opportunity to sell, not buy.
Exactly. The RSI is giving you valuable clues, but you got to know how to interpret them. You can't just blindly follow every signal.
Makes sense. He also talks about using the RSI with other indicators like moving averages.
Oh, absolutely. Combining those tools can really give you a powerful edge.
He specifically mentions using a 9-period simple moving average and a 45-period weighted moving average applied to both the price and the RSI.
That's one of my favorite techniques. Those moving average crossovers, especially on the RSI itself, can give you an early warning about potential trend changes.
It's all about connecting the dots, isn't it?
Exactly. You've got your RSI levels and ratios, your Fibonacci retracements, those MDRPs, trend lines, moving averages. By combining those tools and always paying attention to the overall market context.
You can start to develop a much more well-rounded approach to trading.
Exactly. The RSI is a powerful tool, but it really shines when it's part of a broader strategy.
Well, I feel like I've learned a ton from this deep dive. John Hayden's book really is packed with insights.
It definitely is. It's a must-read for anyone who's serious about using the RSI effectively.
It really makes you realize how much information is hidden right there on the charts if you know how to look for it. And hey, that's what the Deep Dive is all about, giving you the tools and insights you need to level up your trading game. So keep exploring those charts, keep asking those questions, and we'll catch you in the next Deep Dive.